Welcome to the Glass is Half Full talk show. Let's face it, life can be tough in many ways. Here on the Glass is Half Full, we focus on how life is tough financially. Dealing with these financial realities can be a challenge. Essentially, we have to find ways to do more with less. Less money, that is. The show is focused on helping you discover ways to achieve that goal, even if you don't have a lot of money to work with. We'll be meeting people from many different walks of life. They'll share their stories and expertise. Looking to do more with less and maintain a positive attitude while you're doing it? Welcome to the Glass is Half Full. Now let's join Richard and his guests in the studio.
Now today we have with us David Grossman. He's a mortgage agent with, let me see if I get this right, Dave, Loan Central RMA.
That's correct.
And it serves the greater Toronto area. Dave has been arranging mortgages for people for over 15 years now, and he brings to us a wealth of experience and know-how to a business that, I don't know about the rest of you, but I find it somewhat mysterious and maybe just a little bit intimidating. So Dave, welcome.
Thank you very much, Richard, for having me on the show.
Pleasure. Now, I'm going to start with a start-out question, Dave. Okay, for somebody who is just starting out, a first-time home buyer and all that, what do they need to know?
Well, there's essentially a few things that lenders are looking for. Presumably, people would need a mortgage. Most people don't pay cash, so they need to have a savings of at least 5% down.
5% of?
Well, it's 5% on the first $500,000 of the purchase.
So and they need $25,000.
They need at least $25,000.
If the house is worth.
Right, and if the house is worth more than $500,000, they need 10% on the amount between $500,000 and $1 million.
Okay.
And if it's over $1 million, it falls into a different category altogether. They'll need at least 20% down.
So essentially, if they're buying $1 million house, they need $75,000 minimum.
Well, let's see. Yes, you're right. Good, quick math.
My specialty. So, is there anything else they need to know?
Well, besides having a down payment, the other things that lenders are looking for are credit, income, and the type of property. So credit is very important. People need to take steps to establish credit and maintain their credit. And
mortgage is credit, isn't it?
A mortgage is one form of credit, definitely. But for a first-time home buyer, lenders want to see that
a good record.
That they have a history, at least a couple of years, credit bureau. The assumption is people want to get mortgages from the bank or places like a bank, right? So for those types of borrowers, this is what we're talking about when we talk about 5 to 10% down. We're talking about bank mortgages. And they need to have income too. So if they're salaried, the lenders want to see job letter, pay stub. If they've been in the job for less than 1 year, they'll want to see some history of income. And also, as I mentioned, credit. People need to build up some credit.
That stands to reason, doesn't it?
Yeah.
So, if they're applying for a mortgage through your services, through you, okay, how do they go about that? What are the mechanics of doing it?
Well, the first thing people usually do is give me a call. I've got a direct number that people can reach me on, and I'd like to, usually have a quick conversation with people to start. Usually within 5 to 10 minutes, we can determine what's the scope of what's going on? Is it a purchase? Is it a refinance? What's the urgency? Is this a pre-approval, or does somebody need money to pay out a creditor, in 2 days?
Right.
So I like to start off on the phone.
So you know what you're working with, basically.
Yeah, exactly. And then once I know that there's a potential deal, then I will send people my application. It's a 2-pager. That they need to fill out and sign, and I'll give them a list of papers that we'll need as well in order to go after the mortgage.
And then the process kind of rolls from there, doesn't it?
Yes.
Okay. Now, you mentioned that the numbers we were talking about, this $75,000 on $1 million home, the down payment and all that. You said that's with a bank.
Yes.
Okay. Now, there are other places where you can get mortgages, right? Do they not have similar requirements?
Well, I mean, there's a number of what we call A lenders out there, banks, credit unions, trust companies, and with those lenders, you can get what they call high ratio financing. A lot of people have heard of CMHC.
Right.
So CMHC is it's a government-run organization, and they're there to help Canadians buy homes. So when it's an insured mortgage with CMHC or one of the other insurance, there are a few of them out there.
So CMHC is an insurance program.
That's right. It's an insurer, but it's not in the way that people normally think about insurance. You normally people think, oh, I'm getting life insurance for me or car insurance or whatever. This is insurance that protects the lender.
Right.
It comes at the borrower's expense, but it protects the lender.
And how does it help the borrower?
It helps the borrower because now they can get what they call high ratio financing or small down
So
payment.
they still want to buy that $1 million home. How would it help?
So now they can, well, now you can get it with just $75,000 down payment, because if it wasn't for the insurers, like if you don't have insurance on it, you've got to have 20% down if it's not insured.
Oh, see. So the bank mortgage will be through CMHC as well.
Yeah, banks.
So that's where the 75.
That's correct.
$1,000
That's an insured mortgage.
Okay.
Exactly.
And without that,
without insurance, if you have enough money, then you can do it uninsured.
But that would require
but you have
something
to
like
have at least
$200,000.
20%. That's correct. And at least 20% down.
what you were telling me about what people have to tell you and bring to you, and what you discuss with them in your 10-minute initial conversation with them over the telephone, perhaps. Is this different if you're dealing with somebody who's self-employed?
Well, there's a key difference for self-employed people often, in that self-employed people are going to minimize what they report for tax purposes. It's one of the benefits of being self-employed is that you can have legitimate tax expenses.
Let's stress the word legitimate.
Legitimate tax expenses, so oftentimes self-employed people, if they go to the bank, the first thing the bank says is, well, show me your tax returns and notice of assessments. And the net income per the tax return and the notice of assessments are often not really reflective of what's happening. You know, somebody could have $200,000 in sales and their net income is $40,000. The bank looks at the $40,000 and says, okay, we'll give you a $200,000 mortgage or a $250,000 mortgage, but this is somebody who might be able to afford $500,000 or $600,000 mortgage and want a bigger home. So we have lenders, not the prime banks, but we have alternative institutional lenders. They charge between a half a point to a point more than the banks. They'll also amortize the loan over a slightly longer period of time, so even though there's a higher rate, the payment is still affordable. And this way even self-employed people can get the mortgages that they want and still benefit from some of the tax write-offs.
Now, you mentioned A lender before, okay? And I've heard the term A, B, C lenders. How many are there anyways? Does it go
Well, I would say
Z?
A, B, C. Some lenders can go to Z, but I would put them into. I think those are good categories. A, B, and C. Yes.
Okay, those are the normal ones.
Those are the normal ones
you would talk about, right? So, can you tell me, who are they? Like, what makes an A lender, a B lender, a C lender, and perhaps what are some of the pitfalls that might accrue to dealing with one or the other or the other? You know?
Right. Okay. So there are basically three different types of lenders, Richard, and we classify as A lenders, which are essentially prime lenders or bank type of lenders that most people would like to get a mortgage from. That's where you get the best rates. And the best terms too. Right?
Now, other than banks, who else is in that category?
Well, there are credit unions, trust companies, and there are many institutions out there that we consider to be A lenders that people have never heard of, that serve strictly the mortgage brokerage community.
Gotcha. Okay.
So, no shortage of A lenders out there, but they look for people who have very good credit and provable income. And the next category is a B lender. A B lender is also an institution who will take self-employed borrowers, so they're more flexible in how they look at income, and also more flexible on credit as well. So if people have credit issues, they might still be able to get a mortgage from a B lender. So the B lender will charge maybe a percentage point, sometimes more, sometimes less, premium over what the bank's charging.
The banks are charging 3.5. B
So
lender
the
might
B
go
lender
4.5.
could be 4 to 5,
4.25,
depending on
5.
the situation. Right. So that's a B lender, and you know, it's if you can get your loan from an institution, either an A or B lender, that's the best case scenario. If you're in a pinch, there are C lenders, which are also known as private lenders.
Okay.
Private lenders include individuals who just like to lend out money on mortgages, MICs, which stands for Mortgage Investment Corporations, that do private loans. And these are higher risk types of loans that you wouldn't be able to get from an institution, so you pay higher rates, you pay fees. So besides the fact that they're more expensive and should be avoided if possible, the other thing about the private loans or the C mortgages is that they're usually short-term loans. So lenders will want to know what's your exit strategy, or how are you going to repay the loan, and that's an important question.
Right.
As a borrower, if you need it as a bridge to get over a hump, okay, but you know, you got to think long term, right? What's going to happen at the end of the year? If this is a 1-year term and that lender is not prepared to renew the loan at the end of the year, because private lenders don't always want to renew, and if they do, the fees could be very high. So that's, you know, you need to have a plan to get out of that private mortgage, either by refinancing at the end of the year or selling the property.
So, for anybody, whether they're a first-time buyer or anything at all, the idea is to try and get an A lender mortgage, right?
Ideally, you want an A loan, but I also deal with a lot of people who don't mind dealing with B lenders. They don't mind paying a little bit higher because it allows them to save a lot of money on their taxes, as they're not shy about writing down the legitimate business expenses, and they can sometimes save you know, a lot of money on their taxes, and still get the mortgage loan they want, and they don't mind paying a little bit higher rate if it gets them into the property that they really want and can afford.
I heard, like a lot of people, I heard about this, something called a stress test.
Yes.
This is a relatively recent development, right?
Right.
Can you explain that to us?
Sure. So, well, at the beginning of 2018, the government decided that they needed to take some steps to cool down the market.
The provincial government?
This is the Canadian government, the federal government.
Okay.
So they implemented or imposed this stress test, which applies to almost all institutional lenders, except a few lenders that are provincially regulated. But the lion's share of institutional lenders out there are federally regulated, and what this means is that essentially they call it a stress test because you have to qualify for the mortgage as though it was 2 percentage points higher than the rate you're actually getting. So let's say you're borrowing at 3.5%,
right,
and they look at what the payment is and figure out how much you can afford and how much mortgage they're willing to give you. Well, with the stress test, the rate goes up from 3.5 to 5.5,
right,
and then they look at how much they think you can afford, and the result is that you can only get a smaller mortgage. So that has really thrown a wet blanket on the real estate market.
So if you're borderline in terms of your means,
Yes.
okay, it really might cramp your style on.
Yeah, it could
getting what you
definitely
want.
impact. But then there's some changes coming up again soon that are going to help first-time buyers. So I think they've acknowledged that they've done enough to cool off the market, and there's some new incentives coming out to help first-time buyers.
Well, I was going to ask you about that too. You hear there's a lot of public discussion about the government assisting people
Yes.
to be able to get into the market.
Right.
Okay.
Right.
What is there out there for people?
Well, I mean, there's a couple of things. First of all, there's been a program where you can use money that's in your RSPs. That's been around for quite a few years. I think the maximum was $25,000 per person that you could take out of your RSP tax-free. You did have to pay that money back over, I think, 15 years, yes, to put it back into your RSP, but you can take the money out tax-free. I believe the government has just increased that to $35,000 per person. And there's a new thing coming up very soon where they're going to actually contribute something, like be a partner in your home. So I think if you make less than $120,000 a year, the family, and your down payment is 10% or less, that the government, you could potentially get a part of that for the government, and they would eventually be repaid.
Repayable?
Yeah, but when you sell the house, and you have like 25 years to repay them. So I think it's a plus. I think it's a good. I mean, I've heard some.
Well, it's free money for 25
It's free
years.
money.
Yeah.
Absolutely.
No payments necessary on it, right?
There is a payment on it that's required.
Is it?
Yes, I don't want to say there's no
it's
payments.
not totally free.
They haven't released all the details yet, but we should know more very soon.
They have a similar program for RESPs,
Right.
where the government contributes to
Yes.
it.
That's right.
In our business, the insolvency business, we run into these things, as you know.
Yes.
And RESPs, it's not your field, I realize, but RESPs are a factor because they become an asset of the bankruptcy,
Right.
and but not the part that the government has put in.
Oh, okay.
So if there's $1,000 there, and I can't remember the percentage, but let's say for the sake of argument, the government put in 20%.
Right.
Okay, and then it's only worth $800 to your creditors if you're the owner of the RESP. Yeah.
Right.
So I wonder if it's going to be a similar kind of thing.
Well, yeah, it'd be interesting to see how that impacts people in the case of bankruptcy.
Yeah.
Yeah.
Because once they get into bankruptcy, insolvency in general, but bankruptcy. The big difference, of course, is that in the bankruptcy, the property itself is actually on the table. You know, the creditors through the trustee have a right to the equity of the property and all that.
Right.
Okay. Whereas, if you don't get to that stage, if you get into a proposal or something like that, then it's a hypothetical asset.
Right.
It's not really at risk.
Okay.
You know,
Understood.
Okay.
Yeah.
Okay, that doesn't take into consideration, that's not the actual money that the person would end up with if they sold their house, though. Essentially the costs of selling the thing, there's going to be a cost of some kind. So the real equity they might have in that place might only be $175,000 instead of $200,000 or something like that, right?
Yes.
Okay, and that applies across the board to everything, right? Equity is the difference between what a thing is worth against what you might owe on it.
Exactly.